The Zero Income Tax Retirement Series, Part 2. In the previous video, Joe introduced the concept of what we call zero income tax retirement. The key idea was simple but powerful. Federal income tax in retirement is often determined not by how much income you have, but where that income comes from. And when you sequence that income correctly, the tax outcome can look dramatically different. But the real question becomes, when does that planning actually happen? For most retirees, the most important tax planning window is not after Social Security begins. It's the decade before that. At E3 Wealth, we call this period the bridge decade. And for many households, it can be the single most important window in their entire retirement timeline. Before we go any further, I'm John Moriarty, co-founder and managing partner at E3 Wealth. I work with entrepreneurial-minded clients to challenge traditional financial thinking and create strategies that reflect how their wealth is actually built. Now let's get started. Let's think about what your financial life typically looks like between age 60 and age 70. For many retirees, they have left full-time work or are transitioning into retirement. Social Security has not started yet, and required minimum distributions have not begun. That creates something very unusual from a tax perspective. You have income needs, but very little mandatory taxable income. In other words, you have control. And whenever you have control over income timing, you have an opportunity to shape the tax outcome. In the white paper, we discussed a simple framework for using this period intentionally. The idea is straightforward. Each year during the bridge decade, a retiree withdraws just enough from their traditional IRA to fill the standard deduction. For example, under current projections, a married couple over age 65 may roughly have about $35,500 of income completely offset by the standard deduction. So if they withdraw that amount from their traditional IRA, the taxable income would effectively be zero. There is the possibility that no federal income tax is owed in that tax year. Then, for the rest of their spending needs, they draw from the Roth accounts. Because qualified Roth IRA withdrawals do not appear in adjusted gross income, they don't increase the household's taxable income. So the result can look something like this. A retiree needs, say, $125,000 per year to live on comfortably. They withdraw about $35,500 from their traditional IRA, and the remaining $89,500 from Roth accounts. The IRA withdrawal is absorbed by the standard deduction. The Roth withdrawals could be tax-free. And the federal tax bill in those years may be zero. But there's another reason this strategy matters, and it has nothing to do with the current year's tax bill. The real risk, the growing IRA. Most retirees assume that leaving their traditional IRA untouched for as long as possible is a good thing. After all, it keeps growing, but that growth can quietly create a future problem that builds and builds. Under current law, required minimum distributions begin at age 73. And when that happens, the IRS calculates how much must be withdrawn each year based on the account balance. If a retiree enters their 70s with a very large IRA balance, those withdrawals can become substantial. And every dollar of that distribution is fully taxable income. That's where many retirees run into a surprise. They spend their 60s taking minimal withdrawals because they want that account to grow. Then they reach their 70s and suddenly find themselves forced into large withdrawals that push their income taxes higher and higher, and they get into higher and higher tax brackets. In other words, the problem wasn't the IRA itself. The problem was timing. That is why the bridge decade strategy is not just about saving tax in the current year. It's about structural risk management. By gradually drawing down the traditional IRA during the years when taxes are lowest, you reduce the balance that will eventually be subject to required minimum distributions. That means smaller forced withdrawals later, lower taxable income in your 70s and 80s, more control over your retirement income structure. And importantly, it allows the Roth IRA accounts to continue growing in the background. Roth IRAs have no required minimum distributions during the owner's lifetime, which means they can continue growing tax-free throughout retirement. For households that live into their 80s and 90s, those Roth IRA balances often become the most flexible and valuable assets in the entire portfolio. The reason the bridge decade is so powerful is because it only happens once. You typically have no wages, no Social Security income, no required IRA withdrawals. That combination creates a period where your taxable income can be very low, even while your spending remains high. Once Social Security begins and required minimum distributions start, that flexibility becomes harder to maintain, which is why retirement tax planning is often determined before Social Security ever begins. In the next video in this series, we're going to explore some of the hidden landmines that can disrupt retirement tax planning. We'll talk about why Social Security becomes taxable, how Medicare IRMA surcharges are triggered, and why required minimum distributions can quietly push retirees into higher tax brackets later in life. These issues often are treated as separate topics, but in reality, they're all connected. And understanding those connections is what allows retirees to design their income strategy instead of simply reacting to it. If you'd like to explore the full framework behind this strategy, you can download the white paper linked below. And if you'd like help evaluating how these ideas apply to your own retirement plan, we invite you to schedule a conversation with our team. Because when it comes to retirement taxes, the most important decisions are often made years before the tax bill ever arrives.